Rates of return data generated by investments need to be risk adjusted. In order to do so, the nature of the risk of individual stocks and portfolios has to be taken into account. Welcome to this presentation on Chapter 15 of Openstax Finance concerning how to think about investing. Total return from investment is the sum of two elements: capital gains yield, or the price appreciation of the asset, and dividend yield, or the portion of the return that comes from dividends paid by the asset. Capital gains yield is the percentage change in an asset's value from the beginning of a period to the end of the period. Dividend yield is the asset's dividend payment divided by its price. Not all stocks pay dividends. A decision to invest in an asset is motivated by opportunity cost. Investors will invest in an asset if the asset will generate a rate of return that is at least equal to the return of the next best comparable alternative. This expectation is risk adjusted. That is, it asks what an appropriate rate of return is for the level of risk of the investment. The average return is determined as an arithmetic average. Take the sum total returns over a period of time and divide that sum by the number of periods measured. The standard deviation measures the volatility of returns as it measures how dispersed the data is with respect to the mean, also called the average. A high standard deviation means a wide range of possible returns around the average, whereas a low standard deviation means a narrow range of possible returns. The wider the range of possible returns, the riskier the asset, and the narrower the range of possible returns, the less risky an asset is. Consider the standard deviation formula. You can use it with sample data or note that diversification reduces risk, meaning that it reduces standard deviation. You can apply that into the formula to see for yourself. Risk or standard deviation will drop as the correlation coefficients of assets cancel each other out. A risk-free asset has no standard deviation. If the risk-free rate of return is 2%, that asset would generate a 2% return without any variance. The standard example of risk-free asset is a U.S. Treasury security, as the promised return on such a security will be the actual return on that asset without variance. The U.S. government has not defaulted on its debt since the country was founded, so lending to the U.S. government is considered to be risk-free. Individual stocks are risky, and they have average standard deviations of 35%. Investors are risk averse, which is not to say that they don't want to invest in risky assets, but that they will invest in risky assets if the rate of return on these assets compensates them for the incremental risk. High-risk assets will motivate investors to invest in them if they promise a high rate of return to compensate for their higher level of risk. Low-risk assets will correspondingly offer lower rates of return, but ones that will suffice to attract investors. There's proportionality between risk and return. Risk and return go hand in hand. Whereas individual assets have standard deviations of 35% on average, in a portfolio, assets tend to behave differently. Asset returns do not move in lockstep and sometimes move independently. The strength of the relationship between the fluctuations of the returns of different assets is measured by the correlation coefficient. If the correlation coefficient of two assets is 1, they will move in lockstep. They will rise and fall in the same direction, the same degree. Two assets with a correlation coefficient of 0 are totally unrelated to each other and will move independently of each other. Two assets with a correlation coefficient of -1 will move in opposite directions and to the same degree. As you add assets to a portfolio, the standard deviation of the portfolio declines because the correlation coefficients of the individual assets will partially cancel each other out. They dampen the fluctuations of the returns of the individual assets. The overall portfolio will be less risky than the individual stocks in the portfolio, meaning that the portfolio standard deviation will be lower than the standard deviations of the individual stocks. Demonstrating correlation coefficients can be done non-mathematically by showing lines that zig and zag. Perfect correlation of 1 will have two lines zigging and zagging together in the same degree. A negative correlation of -1 will have the other two lines doing the opposite of each other. One zigs, the other one zags. Whereas the average standard deviation of an individual asset is around 35%, incrementally adding assets to the portfolio will lower the portfolio standard deviation. There is an absolute limit to how far the portfolio standard deviation can be reduced. At 40 individual stocks in the portfolio, the limit of risk reduction is reached. The portfolio standard deviation will drop to 20%, but not much lower than this. Growing the portfolio size to 100 stocks or 1,000 stocks will bring with no incremental reduction in standard deviation. The 20% standard deviation that remains represents risk that's undiversifiable, also called market risk or systematic risk. Portfolio risk can be reduced by adding stocks to the portfolio, but only up to the point where diversifiable risk is reduced to zero. Risk can be split into two pieces, diversifiable risk and undiversifiable risk. You can reduce diversifiable risk by adding more stocks to the portfolio. You can never get rid of systematic risk. Diversifiable risk is also known as firm-specific risk or idiosyncratic risk. Systematic risk is also known as market risk. Diversifiable risk can be reduced to zero. "40 stocks is the limit." The capital asset pricing model, or CAPM. The relationship between portfolio risk and the expected rate of return on a stock is captured by the capital asset pricing model, or CAPM. A risk premium is the differential return expected by investors above that of the risk-free rate, as previously defined. The risk premium can be thought of as your reward for being willing to bear risk. For assets that are riskier than the risk-free asset, investors expect compensation in the form of return above that of the risk-free rate. The market is subject to non-diversifiable risk, and the market's rate of return will reflect what is called the market risk premium, which is the difference between the market rate of return and the risk-free rate. The market risk premium is equal to RM minus RF. Using the average return on the S&P 500 to measure what investors who bear the risk earn and the U.S. Treasury bill rate to measure what investors who do not bear risk earn, the risk premium is calculated as the S&P 500 average return minus the U.S. T-bill average return. Beta measures the sensitivity of changes in an individual's assets rate of return and a portfolio to that of changes in the market rate of return. The market, by definition, has a beta of 1 and will reflect non-diversifiable risk. As discussed above, diversifiable risk is reduced by diversification, and non-diversifiable risk will remain. An asset with a beta of 1 will react to market movements in lockstep with that of the market. If the market rises by 10%, the asset's return will also rise by 10%. If the market drops by 10%, the asset's return will also drop by 10%. If an asset has a beta of 0.7, then when the market rises by 10%, that asset's return will rise by 7%. And when the market drops by 10%, that asset's return will drop by 7%. An asset with a beta of 0 will not react at all to changes in the market. Risk-free assets generate their promised return without fail, and despite fluctuations in the overall market, they therefore have betas of 0. The capital asset pricing model is expressed with the risk-free rate plus beta times the market risk premium. The expected return of investment is the risk-free rate plus beta of the investment times the market risk premium, which is defined as RE minus RF. The market by definition is a beta of 1, which when plugged into the above equation will generate a market rate of return. Stocks with high betas greater than 1 will therefore generate higher required rates of return in the market, and stocks with betas lower than 1 will generate lower required rates of return in the market. Risk can be split into two pieces. Diversifiable risk is embodied in the drop in standard deviation from 35% to 20% as you add assets to portfolio. Undiversifiable risk is represented by the 20% floor to portfolio standard deviation. You can reduce diversifiable risk by adding more stocks to portfolio, but you will never get rid of non-diversifiable risk or systematic risk. Diversifiable risk is also known as firm-specific risk or idiosyncratic risk, while systematic risk or non-diversifiable risk is also known as market risk. In evaluating investment performance, rates of return must be evaluated on a risk-adjusted basis. The three measures defined in this section are ratios of rates of return relative risk. The Sharpe ratio takes the portfolio's risk premium and divides it by the standard deviation of the portfolio's return. The portfolio's risk premium is the portfolio return minus the risk-free rate of return, or the investor's return for bearing risk. How much reward is an investor receiving for taking on a unit of risk is the question that the Sharpe ratio answers. The Trainer measurement uses the same numerator as the Sharpe ratio, specifically the portfolio risk premium, defined as the portfolio's return minus the risk-free rate of return. But it divides by beta instead of the standard deviation. This Trainer measurement focuses on systematic risk, as the beta portfolio is the denominator of the equation. In contrast, the Sharpe ratio focuses on total risk, as it uses the standard deviation of the portfolio's returns as its denominator. Jensen's alpha compares the actual return generated by an asset versus the asset expected return based on the capital asset pricing model. Jensen's alpha is equal to RP minus RE, where RP minus RE is defined as RF plus beta P times RM minus RF. If the CAPM sets an expected return for an asset at 10%, but the asset's actual return comes in 11%, the difference between the actual return and the expected return of 1% is the asset's alpha. Investments with positive alphas have generated a return that is higher than expected given the riskiness of the portfolio, termed an abnormal return. Jensen's alpha is meaningful in an absolute sense, unlike the Sharpe and Trainer ratios, which are meaningful in a relative sense. Excel facilitates the calculation of rates of return standard deviation. Excel also can be used to calculate a stock's beta by using a linear regression of changes in the stock's rate of return as the dependent variable versus changes in the market's rate of return as the independent variable. The slope coefficient, or the beta in the resulting equation, measures this responsiveness. You can use Excel to create a scatter diagram showing changes in the stock's rate of return on the y-axis and changes in the market's rate of return on the x-axis, which also reveals the nature of the relationship between the two variables. Figure 15.7 describes creating a scatter plot in Excel using data from Yahoo Finance. The slope of the line that best captures the relationship between two variables is SOT's beta. A simpler alternative regression method would be to take the raw data and determine the slope embedded in the data. The slope is a measure of rise over run, the change in the y-axis versus change in the x-axis. The average return portfolio is the arithmetic average of the portfolio's returns over a period of time. The standard deviation of the portfolio's returns is calculated by applying the standard deviation formula. Note that beta measures responsiveness of a stock's return to changes in the overall stock market's rate of return. It measures an asset's non-diversifiable risk. It does not measure a stock's diversifiable risk. Thanks for watching and listening. Be sure to like and subscribe.